CVP analysis helps with the decision making of cost structuring. How are you going to structure your costs within a business? Are you going to be more weighted heavily on the variable costs, or are you going to be more weighted heavily on the fixed costs? It allows you to do simple analyses to figure out which one's better for your situation. So cost structure refers to the relative proportion of fixed and variable costs in an organization. There are pros and cons to high fixed costs, low variable costs, and low fixed costs, high variable costs costing structures. An advantage of a high fixed cost, therefore low variable cost structure, is that income will be higher in good years compared to the companies with lower proportions of fixed costs. Essentially what we're saying is the higher the fixed cost, the more risk is associated with it. The higher the risk, the higher the reward. Potentially the lower the reward could be depending on a bad year. The disadvantage to a high fixed cost structure is that the income will be lower in the bad years. So again, high risk, high reward, but it also can have a very negative effect on you. Companies with low fixed costs, alternatively, structures enjoy greater stability in income across good and bad years. So this one has lower risk, but it also means that you're going to have lower possibility of rewards. So in the good years, it's not going to be as good, but in the bad years, it's not going to be as bad either. So let's look at an example of this. Or excuse me, let's talk about operating leverage first. Operating leverage is the measure of how sensitive net operating income is to the percentage of change in sales. This is how we measure which one's risky and which one's not, and the outcome of this risky decision, what it could be. The degree of operating leverage is a measure at any given level of sales of how a percentage of change in sales volume will affect the profit. This is your equation for the degree of operating leverage. It is your contribution margin divided by your net operating income. This is going to give you that proportion that says, okay, one, which one's riskier? And then two, what's going to happen to my net operating income with a single degree or a single percentage of change in my sales? So let's look at an example of this now. So assume a company has the following income statement that hasn't changed yet, but they're thinking about switching from commission-based employee payment to salaries. So they're thinking about, currently they're more variable cost heavy because it's commissioned, but they're thinking about getting rid of the commission and moving it to a fixed cost or more salary based. So right now they're higher on the variable cost, low on the fixed cost, that's the commission side. They're thinking about going low on the variable cost and high on the fixed cost, which is the salary side. What is the degree of operating leverage for each option? So let's look at our examples. Let's look at our equations. So again, our equation for the degree of operating leverage is the contribution margin divided by the net operating income. From the commission side, we're looking at a $15,000 contribution margin, and we're going to divide that by the net operating income of $10,000, and that's going to let us know that our degree of operating leverage is going to be 1.5. Now we'll come back to that, what that number means here in a minute. Let's do the salary one now. The contribution margin here is $20,000, and the net operating income is still $10,000. So we divide that out. That's going to give us a degree of operating leverage of 2. Now, first and foremost, that lets me know that salary is going to be the more risky one because the number is higher. But there's also something else you can do with that. Let's assume that what happens if sales increase by 20%? So maybe this is what we're actually having right now, but the management team's asking you, well, what happens if we do something and the sales increase by 20%? What is the effect on our net income? Using both of these examples. So what we do is we take the magnitude of the percentage increase in sales, so 20%, we're going to take 20, and we're going to multiply it by the degree of operating leverage. So we'll take 20 times 1.5. That means that our net operating income will increase by 30%. So a 20% increase in sales will translate to a 30% increase in net operating income based on our degree of operating leverage. From the salary side, again, 20% times the 2, that means under the salary, our net operating income will increase by 40%. So again, in the good years, again, if we increase sales by 20%, it's going to be better if we go to the salary side because it's more risky. The higher the risk, the higher reward. We get more of a percentage increase in net operating income. What if we change it to the sales decrease by 20%? Well, we can do the same thing, 20 times 1.5. That lets us know it's going to be a 30% change, but this time it's only going to be a 30% decrease in change. Whereas if we do that for the salary side, it's a 20% decrease, which is going to lead to a 40% decrease in net operating income. So again, in the good years, the salary is going to be the better one because you're going to get more of it. But on the bad years, it's going to cause you to lose more. So maybe you want the consistency of the commission to even out those. So that's the benefit of the degree of operating leverage.